A little bit more of the market reaction is Ryan Lamond, CEO and co-founder at Neovision Wealth Management. Ryan, we were just talking to our reporter about some of the latest news on the tariff front. Are you getting any more clarity about what this could potentially look like leading into April 2nd? Where do you stand on this current tariff talk?
Well, it's confusion. It's a total uncertainty. So no, I don't have any answers because every day brings something new. We were at large scale. Now we're more focused, and the markets, unfortunately, are moving at the tune of this. So we have zero uncertainty at the stage, and add to it overvaluation. Price to sales above 5. PE sometimes 200, driving the market with NVIDIA, for example. Yes, we are in total uncertainty, unfortunately.
Ryan, though, we did mention we saw equities, at least in the U.S. on Monday, rising to their best day in 2025. Could that momentum keep up?
This will pretty much depend on what is the next move regarding tariffs. If tariffs turn out not to be so focused and more large scale, then probably not. We don't expect U.S. equities to continue at this upward path that happened last night following the good news from more focused tariffs. However, if they turn out to be more focused, then yes, obviously we will go back to rallying. However, I'm not sure they will be so focused because let's look at President Trump's aim. It's to generate revenue, to lower taxes. And the U.S. imports $3.3 trillion of imports. So even if President Trump imposes 50% tariffs, this is just a small fraction of tax receipts. So tariffs will have to be higher to have an impact on the U.S. economy. So not sure how they can be focused, but at the same time, lower taxes.
Where does that place you, Ryan, and where you want to invest right now? Do you step away from the U.S. at this point until there's more clarity, or where do you focus?
Because there is overvaluation in U.S. equities, we're very close to the year 2000 tops. We have rotated away from the U.S. to a large extent, and that was a few months ago in preparation for what's happening today. And we've gone into Chinese equities, we've gone into European equities, we've gone into Indian equities, and we've done extremely well there. Also, 25% of our portfolio has been gold. We've done very well there as well. We've booked some profits at $3,000. And we're waiting for the pullback to go back in. So the advice to investors is diversification, geographic diversification, and staying away from what is very overvalued, because this will be the most volatile risk assets.
Where do you see the pullback, though? What is the pullback for? What's the catalyst for the pullback for gold, Ryan?
The pullback for gold is a detente on the geopolitical front, potentially a resolution of the Ukraine issue, potentially a meeting between President Trump and the Chinese authorities. So any detente of any kind on a geopolitical trade perspective could cause a pullback in gold. However, as of today, all of the elements that have caused gold prices to go up are still there, among which BRICS central bank countries buying gold.
Ryan, you mentioned that we're close in terms of valuations to the 2000 levels that we saw. Does that mean that you potentially think we're headed towards a potential bubble, and this could soon be even more detrimental if you continue to be overweight in the U.S.?
Oh, we believe we are in a bubble in the United States equities, and particularly in the tech sector. So this bubble can last a long time. I'm not saying it can burst anytime soon. And the catalyst for this burst is basically China. And we've seen it as soon as DeepSeek was announced at a very awkward timing. If there's more news on the tech side from China, creating cheaper AI, cheaper chips, etc., this could be the catalyst to lower U.S. equities, specifically the tech sector, to more reasonable valuations. But until this happens, this whole party can continue for a long time.
Have you decided yet what sectors in Europe, Ryan, you would invest in at this point? Because Europe is sort of, stuck in the middle of a few different stories and headlines right now.
Well, the most obvious sector is defense, with all of the European announcements with regards to spending on their defense budgets. That's not a sector we like very much for many, many reasons, but it is the most obvious sector. And anything related to the defense sector will be dragged up because clearly Europe will be spending quite large sums of money on defense, given what's happening on the Eastern Front.
All right. We'll leave it there with you, Ryan Lamont. Always great to get your insights. CEO and co-founder at NeoVision Wealth Management. Thanks so much, Ryan.